Every investor loves the sunshine, the bull runs, the green candles that seem endless. But wealth isn't built during the calm. It's forged in the storm. Because when markets crash, panic spreads faster than reason. Screens turn red, headlines scream fear, and even seasoned investors begin to doubt their own plans. This is where strategies are tested, where theories meet reality. And here's what most people get wrong. The goal isn't to avoid volatility, it's to survive it and position yourself for what comes after. A momentum-based ETF does this by quietly adapting. It doesn't fight the storm, it shifts with it. Every few months, it re-examines the market landscape. It looks at the data, not the drama. When risk appetite fades, it automatically pivots. From growth sectors like tech and consumer innovation to steadier ground, healthcare, energy, utilities, essentials. This constant recalibration keeps your portfolio alive, not frozen in the past, but responsive to the present. Traditional index funds hold everything, the winners and the losers, side by side. They wait for the world to fix itself. But adaptive systems? They move as the world changes. They don't need predictions, they don't chase hunches, they just listen to data and adjust their sails as the wind shifts. Let's go back in time for a moment. 2018, markets shaken by trade tensions. Most portfolios fell sharply, but adaptive, data-driven strategies softened the blow by rotating into sectors less exposed to risk. Then came 2020, a once-in-a-century collapse that hit faster than anyone imagined. In weeks, entire economies froze. The world panicked. Yet, as the market began to recover, what led the comeback? Technology, digital growth, innovation. And guess what? The adaptive ETFs, already tracking momentum, shifted naturally toward those sectors before the headlines caught up. That wasn't luck. It was design, a process that rewards resilience and trims weakness. Then came 2022, another test. Inflation, rising rates. The kind of chaos that wipes confidence clean off the charts. Traditional index investors felt every shock, but adaptive strategies? They took hits, sure, but smaller ones. They lost 10% instead of 18%. And here's why that matters. A portfolio that falls 18% needs a 22% rebound to recover. A portfolio that falls 10%? Only 11%. That's the silent power of adaptation. You shorten the pain, you accelerate the comeback, and over time, that difference compounds into real freedom. And while many dismiss momentum as chasing winners, that's not what's happening here. This is discipline disguised as movement. A math-driven rotation, free of emotion, fear, or ego. You see, a smart ETF doesn't try to outsmart the market. It moves with it. It steps back when markets grow defensive and steps forward when confidence returns. That's not guessing, that's evolution. And here's the irony. Most people think staying still means safety. But in investing, stillness can be the riskiest move of all. Because when the world changes and you don't, you fall behind without realizing it. Adaptation doesn't eliminate risk, it redefines it. It turns uncertainty into motion. It transforms fear into focus. That's why, over time, these smart systems often reach new highs faster. Not because they avoid pain, but because they recover stronger. So when the next storm comes, and it will, remember this. Markets don't reward panic. They reward preparation. And the investors who adapt with the data, not against it, are the ones who come out stronger on the other side. A market crash isn't the end of the journey. It's the test that proves whether your system truly works. You say it. Because true resilience isn't about perfection, it's about response. And when your investments can bend without breaking, that's when you finally start compounding freedom, not fear.